Welcome to CARES Act and Partnerships, Navigating Time-Sensitive Issues and Refund Opportunities, sponsored by the ABA section of Taxation. We are joined on the program today by Shamik Trivedi, Mark Walensky, Monisha Santamaria, Sarah Harridan, and John Finkelstein. Shamik is a senior manager with Grant Thornton LLP, and he's located in Washington, D.C. Mark is a partner with Meltzer, Lippy, Goldstein, and Brightstone LLP, and he is located in Mineola, New York. Monisha is a legislation counsel at the Joint Committee of Taxation. She's located in Washington, D.C. Sarah is a partner with Holland and Hart LLP, and she is located in Denver, Colorado. John is a principal in the Pass-Throughs Group of KPMG LLP's Washington National Tax Practice, and he is located in Washington, D.C. So panelists, you may proceed with today's program.
Thank you very much. Good morning, good afternoon, wherever you're located in the United States. My name is Sarah Harridan, and I am a Vice Chair of the Partnerships Committee of the ABA Tax Section. Welcome everyone to the CARES Act and Partnerships, Navigating Time-Sensitive Issues and Refund Opportunities webinar. This webinar is co-sponsored by the Partnerships and Real Estate Committees of the ABA Tax Section. We have an exciting and informative presentation prepared for you today. The presentation is broken down into three sections. The first section provides an overview of various procedural guidance relevant to partnerships and their partners that has been issued by the government since the COVID pandemic, some of which interprets or supplements the CARES Act legislation. The second section of the program, we're going to discuss certain options for taxpayers available under the CARES Act and subsequent guidance to access cash and how those options are applicable to partnerships. And then in the final section of the program, we're going to discuss certain real estate specific issues in assessing cash options and additionally talk about and provide an overview of some real estate specific guidance. As the operator explained at the beginning of the program, we are going to aim to save 10 to 15 minutes at the end of the presentation for questions. Please go ahead and feel free to submit those questions throughout the webinar through the webinar format that was discussed, and we'll try to get them all answered at the end, but it would be helpful if we could see them as you're thinking about them. So with no further ado, I will pass the microphone over to Shamik to get us started. Thank you.
Thanks, Sarah, and thanks to everyone joining us today on what is, I think, a very important topic for us as practitioners and for our clients. And so let's get right into talking about the procedural considerations here that have been put out as part of the CARES Act and the IRS and Treasury's response to the ongoing pandemic. Some of this, I think, is good background. It's nothing new. There was an ABA webcast a couple of weeks ago that went over this. So we're not going to spend too much time on the filing relief that's been put out by the government, but we want to spend a couple minutes just talking about what's out there, because there has been quite a lot. So as you may know, on March 13th, the President declared a national emergency, and that followed in succession with various notices by IRS and Treasury that we've outlined here. And the gist of this is there's broad relief in postponing due dates under Section 7508 Cap A, and by extension, Rev Proc 2018-58 for performing certain acts that are required under the Internal Revenue Code and regulations. So the effect of this postponement is that the period of postponement, which is April 1st to July 15th, is simply disregarded by the IRS. It would not be correct to think of this as an extension of time per se, because the extension period, and this is a common question that has come up, it runs concurrently with the postponement period. So if you are a taxpayer that's eligible to file a extension by July 15th, it doesn't mean you have until January to file your tax return. At least it might not mean that yet. We don't know what's going to happen over the next several months. But as the law currently stands and as how guidance has been issued, your current extended due dates of September 15th or October 15th remain in place. You don't need to do anything to get this release. It is automatic, so each taxpayer can rely on what's been put out. So while the regulations under Section 7508 Cap A and Rev Proc 2018-58 provide guidance on what acts are postponed by taxpayers, there's also a provision under 7508 Cap A-1C2 that allows for certain postponement, in this case a 30-day postponement of time, for the IRS to take certain actions. So that 30-day postponement is not the same as the July 15th postponement, but it does allow an additional 30-day period of time for those enumerated acts in that bullet point. And -1C2 also provides some additional information and acts that can be performed by the government. I want to just quickly mention that it's vitally important, I think, for us as practitioners to carefully review 7508 Cap A-1 and Rev Proc 2018-58. I think for many of us that might be practicing in the Gulf states or in Texas or Florida, 7508 Cap A is a very commonly used provision, just given the occurrences of federally declared disasters in that area. It might not be something that a lot of us outside of that area have thought about all that much. So 2018-58, that revenue procedure, has a lot of answers to the commonly asked questions of certain filings, certain elections, et cetera. So it is important to review that particular piece of guidance. I'd also say that in terms of IRS examinations, the People First Initiative, which was rolled out by LB&I and the IRS several weeks ago, has some important information and leniency in terms of what LB&I is doing in terms of IDRs, new examinations, other information that's required to be submitted to the IRS. Notice 2020-26 separately extends the time for filing Forms 1139 and 1045. We are going to talk briefly about the application of those tentative refund forms and those rules to partnerships. And there's also temporary fax procedures that have been put out by the IRS, just given the closure of the Ogden, Utah Service Center. So these are also very important provisions for partners of partnerships, and the procedures that have been put out, especially for the filing of a Form 1045 for an individual, might limit the ability of individuals to actually claim a carryback loss on that particular tentative refund form. So we're also going to discuss later on in this presentation the particular procedures over that claim. In terms of partnership-related provisions, for the 2019 calendar year, the unextended due date of March 16th was not touched by the Notice 2020-23 or its predecessors. It's effective, that guidance, as you might know, is effective April 1st onward. So if you did not file a partnership tax return on March 16th, I hope you would have extended that filing to give you until September 15th. If you did not file an extension, then you might have some late filing issues, in which case you should probably consider a reasonable cause statement. If the partnership did timely extend the filing of Form 1065, then that form is due September 15th, as I mentioned previously. And if they did not extend, if you filed it timely on March 16th, there are certain circumstances that we're going to talk about in this presentation on the ability to file an amended return under Rev Proc 2020-23 as opposed to filing an administrative adjustment request under the BBA. So the BBA, obviously a huge topic for both procedure and partnership practitioners. So we're also going to discuss in just a few moments the process for filing an AR and the process for filing an amended return under the Rev Proc and the pros and cons of doing either. Finally, and this comes up quite a bit, there was not a postponement of the due date, the original due date for Forms 1042 or 1042S. So that just goes to reviewing RevProc 2018-58 quite carefully. The BBA. So, we've talked about the BBA numerous times on webcasts for the ABA and other organizations. We've talked about it at panels at our annual meetings many, many times over the past 5 years or so. But to give folks just a general primer on the BBA, it replaces TEFRA and the electing large partnership rules. It's a streamlined, centralized partnership audit regime that was designed by Congress to facilitate the collection of tax. So for those of us that have been in practice for several years, you might have known how difficult it was for the IRS to collect tax going up many, many tiers of partnerships. And so the BBA aims to correct that issue. Generally, a partnership under the BBA may pay an imputed underpayment or tax on behalf of its partners as a result of an audit adjustment under 6225. Alternatively, there's a push-out regime under 6226, which pushes out, as you might see, the adjustment to the reviewed year partners. So 6225 and 6226 are important just for purposes of what a partnership might want to do and who bears the economic burden of that payment by the partnership. The default rule is that the partnership pays, so the current partners are effectively on the hook for that imputed underpayment. By pushing out, you are pushing back the adjustment to the year that is under examination or the year that's being adjusted, the adjustment year. So there's a preference there for certain partners to bear the burden, perhaps, and that's a consideration that the partnership has to take into account. BBA is effective beginning for taxable years after 12/31/17, although there are early election in provisions that we're not going to discuss on this webcast. BBA partnerships, of course, 100 or fewer partners. Each one of the partners has to be an eligible partner as described in that middle bullet point, and there are special rules for S corporation partners and counting the number of shareholders of the S corporation. If you have a partner that's a DRE or another pass-through, you're subject to the BBA. It's that simple. Consistency rule, and you might question why we're talking about this sort of particular rule of the BBA. It has to do a lot with RevProc 2020-23 and the requirement under Section 6222 that a partner's return be consistent with the partnership's return. If that return is not consistent and the partner has not given notice to the IRS that it is taking an inconsistent position from that of the partnership, the IRS has the right to assert a math error or a computational adjustment to, in a sense, correct the partner's return. So we have a brief example here of a partner receiving a K-1 from a partnership. The partner disagrees with the characterization of an item of income. Partner must disclose that intention to treat the income differently from what was reflected on the K-1. And if they do not do that, then the IRS can take that math error authority and essentially correct the partner's return. So that's an important thought here, and RevProc 2020-23 doesn't simply do away with the BBA, as we're going to learn. So it's important to keep in mind that consistency is still relevant and very important under the current partnership taxation regime. Partnerships can also not amend or change a tax return or a K-1 under the BBA unless one of four provisions is met. And in particular focus is going to be that fourth provision, which is the IRS's exercise of authority under RevProc 2020-23 to allow for an amendment of a 1065 or a K-1. So that's the technical authority for filing an amended return. So AARs, I know this is an area that's of great interest to folks because it is such a new way of doing business as a partnership. So as I mentioned, the only way to amend a partnership tax return currently, putting aside RevProc 2020-23, is to file an AAR, and to be even more precise, to amend a BBA partnerships Form 1065. So an AAR is the filing of an 8082 and the 1055 to reflect the adjustments in the year in which the AAR is filed. So, for example, and we have a great example coming up in a later slide, an AAR filed this year to adjust the 2018 tax year would require the adjustments to be taken into account in 2020, which is known as the reporting year. So depending on whether that adjustment is going to result in an imputed underpayment or a potential refund opportunity, or as the regulations provide, a situation in which there is no imputed underpayment, that is a consideration to be made, and in determining when the imputed underpayment is to be paid, there is an option for the partnership to pay, as we discussed under 6225, and if there's not an imputed underpayment or a refund opportunity, there would be a requirement to push out much as you would have the opportunity to push out an imputed underpayment. This is, as you might have already ascertained from me just talking through this, a complex set of calculations, both quantitative and qualitative by the partnership, and it could have a lot of unintended consequences. We don't see a lot of experience with AARs necessarily, and there's also a provision under 6235 that would allow for the extension of the period of limitations to adjust an AAR. So filing an AAR is not a small ordeal. It does require a lot of deep thinking.
Shani, can I stop you and ask a question? Maybe just pose it to the whole group. Have people seen a lot of AARs being filed since sort of the effective date of the BBA?
Sarah, thanks for that question. No, in my experience, not really. And part of that is because there is a relative confusion on how a partnership might file an AAR, and also how a partner is required to take into account the effect of an AAR. And there's some of these forms on the screen right now. And so, no, I've not seen any. I'd be curious to know if my colleagues have.
This is John. I agree with Shamik. I think people are just now grappling with this whole the procedural aspect that Shamik has been going through, and the complications associated with filing an AAR. In fact, a lot of people don't even realize that you generally can't amend a partnership return anymore, putting aside the recent changes that have come out in the RevProc. But yeah, I think people are still grappling with this. It's a complicated procedure, and in some cases does not give you the benefit that you might like. I'd say there's more attention being focused on it right now with the CARES Act changes, and we'll go through some of that and all the choices to be made in terms of timing of getting access to cash. But I really have not seen a lot of it prior to this point.
So on the screen you can see some of the forms. This is not an exclusive list, but it is a general rundown of the various forms that partners and partnerships are required to file as a result of an AAR. There's a statement that's issued to the partners, which is colloquially a bit like an amended K-1. There's a pass-through statement by the partnership, and then when I mentioned that there's some confusion among partners themselves, it's because of this additional reporting year tax calculation and form that is to be reflected on the partner's reporting year tax return. So the 2020 return, the year in which the AAR is filed. That's sort of the reason why the IRS issued RevProc 2020-23. So for example, if you have a partnership that files an AAR in 2020 to reflect deductions related to the CARES Act, which we will talk about in detail later on, that might result in an adjustment to taxable income that results in a refund opportunity for that particular partner. If you're filing an AAR, it means that those adjustments are taken account into 2020. So the partnership issues the AAR statements in 2020. The partner would then calculate the adjustment to tax in 2018, the adjustment year, and each subsequent year up to 2020, and then you would reflect the aggregate, quote-unquote refund on your 2020 tax return that's filed in 2021. Now, the kicker here is that the adjustment from 2020 would reduce your tax due for the adjustment for 2018 would reduce the tax due for 2020, but not below zero. It's not a refundable credit or refund. So you're effectively limited in this case to the amount of tax you've paid in or your tax liability. So consider if you have very little tax liability in 2020, an AAR may not give you the full benefit because there might be a limited amount of tax to offset in 2020 as a result of a potentially larger refund from 2018. So this is a extremely important consideration, obviously, for filing an AAR, because you may not get the full benefit you think you're getting, and an AAR is not as simple as making an adjustment that's carried forward and reflected in the current year. It's a calculation of tax in a prior year that's applied forward to 2020. So that is another big consideration on whether to file an AAR. So if you don't want to file an AAR, the IRS has issued RevProc 2020-23, which allows for a partnership to file a 1065 amended. So the retroactive benefits of the CARES Act, if filing an AAR, as I mentioned, and the IRS puts this front and center in the RevProc, would only be realized by the partners of a BBA partnership in 2021. And most partners and businesses need cash now. So an AAR might not be the best bet for increasing short-term liquidity. So there's certain requirements to filing an amended return under RevProc 2020-23. It applies to BBA partnerships that filed the 1065 and furnished Schedules K-1 for years beginning in 2018 and 2019, and that those returns and K-1s are filed prior to the issuance of the revenue procedure on April 8th. So, for example, if you were that March 16th partnership that filed your 1065 and issued your K-1s, you would potentially be eligible under RevProc 2020-23, assuming you met the other requirements of the guidance to file an amended 1065. The eligible partnership would file the amended 1065 and the K-1s prior to September 30th, 2020. So there is a deadline here. And you would have to take into account, you can take into account literally any adjustment, not just those related to the CARES Act. So, for example, if you're a partnership that is not going to get any benefit from the CARES Act, but there's, let's say, an extender credit that you're going to benefit from, you could file an amended return under these procedures. It doesn't have to be solely for CARES Act-related provisions. If you already filed an AAR, the amended return that you're filing should reflect the as-adjusted AAR items. In effect, the amended return is replacing a prior return that's being filed. And there's a coordination rule with Notice 2019-46, which allowed for the application of proposed GILTI regulations under Section 951 Cap A. So that coordination rule is also worth considering because it does require some consistency in some cases. Now, special considerations with RevProc 2020-23, like I said, the BBA still applies. The AAR provision is relaxed, but the consistency rule is still in effect. So if you have a partnership that issues amended K-1s to its partners, the partner would have an obligation to also file an amended return upon receiving that amended K-1, which does sort of jive a little differently from prior to the BBA, where it was not uncommon for a partner to receive an amended information return, such as an amended K-1, and do nothing with it. There is, no requirement under the code to file an amended return. There are obviously ethical considerations in Circular 230 reasons for why an amended return should be filed, penalty protection being another reason. But in this case, if you don't file the amended return, the IRS can exercise that mass error authority under 6222 to correct or adjust that partner's return. The wrinkle here also for individual partners that would be filing a refund or an amended return on a 1040-X is that a 1040-X is required to be filed on paper. And this has a direct inability under the tentative refund temporary fax procedures to file that Form 1045 via fax as opposed to mailing it. So that is another consideration. If the filing of an amended return is going to create a loss that might be eligible to be carried back, then that individual might want to consider whether an AAR is a better alternative, or the partnership should consider. And that's another wrinkle there. You don't need to file an amended return if you don't want to. The BBA partnership can still file an AAR and claim that benefit in 2020. But as I said, it's just going to be a timing issue. So I've got a few minutes left before I'm going to pass.
Sorry, Shmi, can I stop you? I just have a question on the last slide. Sorry.
Sure.
So given that the partners have to file consistently if the partnership files an amended return, I guess I'm just wondering if you would see situations possibly where the costs, I'm thinking more the administrative costs of filing amended returns would outweigh the benefits, especially potentially in complex tiered structures of partnerships. Are you seeing that at all, where the cost of all of these administrative costs of new Schedule K-1s and amended partner returns all the way up the chain are just not worth it?
For sure. That's a great question. Now, amended returns obviously are, you're refiling a return, but your return preparer needs to attest to everything in the return. And so it's not a small thing to simply file an amended return for most partnerships and most partners. And so cost is certainly a consideration. I would also argue that AARs are not simple either. The filing of an AAR is a complex undertaking by a partnership that has different consequences. It's a reflection in the current year. It doesn't require other partners to also file amended returns. And so some of this, I think, is a balance between the ease of use by the partnership and its partners, the degree to which a partnership is willing to, for lack of a better word, burden their partners by having to file amended returns. There's no simple answer, unfortunately, to either situation. And I think that's part of it goes to just all these considerations, right? So the consistency rule is in effect that might require an amended return by a partner, but there's also impacts on when the benefit is being borne for those partners, or whether a particular partner is not going to be benefited somehow through the release of a credit or something else. So there's not a great answer to that question. I think both the amended return and the AAR offer benefits and burdens to the partners. And at this point, there's just not that much experience with AARs, in my opinion, that it makes for a clear-cut, cost-effective one way or another. As for refund opportunities and considerations, just moving to slide 17, I think in the midst of this pandemic, it's important to consider that the service centers are still generally closed except for these mission-critical functions. The fax capabilities are there for 1139s and 1045s, but you need to consider the consequences of an amended return by a partner. There's other sort of liquidity-based considerations that we're not really going to talk about here, but you can see of filing quick refunds or delaying the time to pay tax. And then finally, the amended return itself could trigger a joint committee review. So that's another thought. Real quick, because I know we're running out of time, I do want to go through this quick example, which I think John might be discussing a bit in his presentation as well. But this is a real-life consideration here. You have a partnership that wants to adjust its 2018 return to claim energy credits and QIP. And what can they do? And I see this as being three potential options. There might be more, but here are three. You can amend the return, which comes with institutional knowledge and experience by return preparers in amending a partnership return or an individual's return. And you can file that refund claim immediately. The downside is you might have a joint committee review depending on the size of the refund. If your claim is being paper filed, that can take a long time to process. And the consistency rule of requiring partners to amend is also in effect. An AAR is another option, as I talked about, but there's not that much knowledge and experience by partnerships yet on how to file an AAR and what partners need to do when they get their statements and what they need to reflect on the reporting year return. And then that refund, of course, could be limited by the amount of income you have in 2020, and even then not realized until potentially 14 or 15 months from now. And what, the third option is what can you do right now? Well, if it's QIP, you might want to consider filing that accounting method change in 2019 and then dealing separately with the other provisions, the amended return or AAR, to reflect the energy credit. So there's a lot of stuff to think about here, and it's going to be dependent on the partners. And then finally, the due dates here. So just because you have until September 30th to file an amended 1065, if you have a partner that has a 2018 year end that is potentially capable of filing a carryback claim for an NOL, well, then that due date for filing that amended return is not September 30th necessarily. It might be much sooner. So I want to just point out also that second due date of June 30th, to clarify, that's for notice 2020-26, which is the governing provision of that due date there. It adds on 6 months to the due date for the 1139 or the 1045. So if you have a year that ends other than December 31st, you might have a different due date for that 1139. It might be a date other than June 30th, 2020. So a lot there. We're going to have more opportunities to talk later with questions and answers. But for now, I'm going to pass it over to John Finkelstein, who's going to go through some of the path to access cash provisions of the CARES Act. John?
Okay, thanks, Shamik. That was awesome. A lot to think about there. I agree with everything Shamik said, and I think a lot of what our clients are struggling with is there are so many options, so many timing periods to consider, and what is the best path to accessing cash from the CARES Act changes or other opportunities in the code. And what we tend to see clients doing is putting together, it's really a matrix. There's no easy answer to these questions, as we found that they really require a significant amount of modeling to understand what the overall impact of any particular decision will be. In terms of the analysis here, and I think also what the CARES Act changes were trying to do in terms of giving taxpayers the ability to access cash, is really three components of this. Number one, at the top of this slide 21, you can see there's the ability to increase your amount of deductions. So the technical correction to qualified improvement property, which we'll talk about, the relaxation of the business interest expense limitations, talk about that some. Another area that's come up a lot in discussion with our clients in particular is disaster losses under Section 165I, and the ability to actually create deductions that have resulted from the current COVID-19 disaster and apply those losses back in your 2019 tax year instead of having to wait until you're filing your 2020 tax return, in the ability to potentially reduce your 2019 tax liability, create an NOL perhaps, carry that back, access cash in different tax years. So a lot of opportunities potentially there with disaster losses. So again, first, this ability to increase your amount of deductions. Now, if you're able to increase your amount of deductions, you've got to also be able to take those deductions. So the second component here is a temporary removal of barriers to increased deductions. So in the CARES Act, we've got the temporary withdrawal of Section 461L. That's the excess business loss limitation, which came in with the Tax Cut and Jobs Act back in 2018, would have limited an individual's ability to take losses to their amount of business income plus $250,000 for an individual, $500,000 for a married couple filing jointly. That provision has now been effectively repealed back to 2018. It'll come back into effect in the 2021 tax year. One thing just to note on that, which is a little bit of a trap for the unwary that we've seen, is if you had a 461L limitation, let's say in 2018, that then turned into an NOL that you were carrying forward, the change to Section 461L now no longer applying for the 2018 tax year means that 461L limitation that's turned into an NOL carry forward is now gone. And so what you need to do is go back and amend your tax return to take advantage of this change, take advantage of the full loss deduction that you could get, turn that into an NOL, and then treat it accordingly with the current rules. A second change, the temporary removal of the 80% taxable income limitation for NOLs. That's obviously a big change. Again, that one applies up until your 2021 tax year. So for your previous tax years, for your 2018, 2019, 2020 tax years, you'll be able to take 100% of your NOLs, even if you don't, even against whatever your taxable income is. You're not limited to 80% of your taxable income. So these two changes allow you to access the additional deductions that you've been able to take. And then the third component here is to provide flexibility on the timing of that impact. Some of this goes back to what Shamik was saying and your different options for making changes that have come up. There's IRS and Treasury guidance related to method changes, specifically with QIP and other method changes that you can now effectively choose what year you make that change. Changes to real property, trade, or business elections under Section 163J, the ability to amend BVA partnership returns or to file an AAR, so it gives you flexibility on what year that change gets taken into account. Also, the ability to now carry back NOLs in the CARES Act, the ability to carry back NOLs 5 years for your 2018, 2019, 2020 tax years. This is a significant opportunity. So if you're creating NOLs through these losses, you can carry them back potentially to years where corporations, for instance, were subject to a 35% tax rate. So you actually get a better result from the NOL than taking the loss in a later tax year, now that we have a 21% tax rate applicable to corporations. So a lot to think about there. Again, as I said, it requires really creating a matrix and modeling all of these changes out to understand exactly what the impact will ultimately be. So let's turn to some of the specific changes. We'll start with Section 163J and the changes made under the CARES Act. As I'm sure everyone is aware, the general operation really quickly of Section 163J, that taxpayers are generally limited to 30% of their adjusted taxable income plus business interest income plus floor plan financing interest expense. So that has been the limitation that applies to business interest expense with the Tax Cut and Jobs Act changes back to 2018. For partnerships, of course, if you have a limitation at a partnership level, the limitation amount gets allocated out to the partners as excess business interest expense, and then the partner really carries that forward until they receive an allocation of excess taxable income or excess business interest income that treats that excess business interest expense as freed up, paid or accrued by the partner at the partner level, and then the partner applies their own Section 163J limitation at their level to determine how much of that now paid or accrued interest expense can be treated as deductible under Section 163J. So what the CARES Act changes do to 163J, it loosens up the Section 163J limitations, and there are different rules that apply for non-partnerships versus partnerships and their partners, which are shown on this slide. So if we work across the top for our non-partnership taxpayers, including S corporations, for the 2019 tax year, we have an increase to the limitation to 50% of adjusted taxable income. Now, taxpayers can elect out of that 50% increase from 30%. And then for the 2020 tax year, a non-partnership taxpayer can apply, again, the 50% of ATI limitation in 2020, again, subject to the ability to elect out of that change. And then what could be a significant change in light of the current economic situation is that for purposes of calculating your 2020 tax year limitation, you can elect to use your 2019 adjusted taxable income instead of your 2020 adjusted taxable income. Presumably your 2019 adjusted taxable income would be a much higher number than your 2020 given where we are today. So that is the general rule for non-partnerships. Of course, partnerships are always a little more complicated. And so for partnerships in 2019, partnerships stick with the 30% of ATI, the historic 30% of ATI limitation that is applied since 2018. And then when you move into the 2020 tax year, that's where partnerships can now use a 50% of ATI calculation. They can also elect, similar to non-partnerships, elect to use their 2019 ATI instead of their 2020 ATI. And then for the 2019 limitation amount that was carried forward, allocated out to partners and carried forward as excess business interest expense, the CARES Act allows 50% of that 2019 excess business interest expense to be automatically treated as paid or accrued in 2020 by the partner, and then allows that amount to be deducted by the partner, not subject to any additional Section 163J limitation at the partner level. The balance of the 2019 EBI carry forward, the other 50% is subject to the normal rules that would normally apply to excess business interest expense. You'd have to wait until there's an allocation of excess taxable income or an allocation of excess business interest income to allow that other 50% to be treated as paid or accrued by the partner, and then potentially deductible by the partner depending on the partner's own Section 163J limitation. So that was a quick overview of the changes to Section 163J. I want to bring Monisha in here and ask Monisha just a couple of questions about the development of these rules. First, if we see on slide 23, there seems to be a disparity between the amount of the overall limitation with respect to a particular adjusted taxable income amount for a non-partnership versus a partner of a partnership when you take into account both the limitation at the partnership level and the partner level. For example, a non-partnership taxpayer, if they had $100 of ATI, under the CARES Act changes, it seems that in 2019, that would give them, that taxpayer, the ability to deduct $50 of their business interest expense. And then the other $50 would carry forward into the following year. So $100 of ATI gives you a $50 interest expense deduction potential. Whereas in the partnership context, that same if you have $100 of ATI at the partnership level for 2019, as we said, that gives you $30 of limitation in 2019 at the partnership level. The other $70 of limitation effectively goes out to the partner. And so if you had another $70 of, let's say, business interest expense, half of that $70 would be deductible in 2020 automatically without any additional adjusted taxable income. So it seems that you're getting $65 effectively of potential interest expense deduction on $100 of ATI versus the $50 of interest expense deduction for non-partnership taxpayers. So Monisha, was that sort of a disparity considered? Is that intended? And you know, what was the reason for it, if it was, or what was the reason why partnerships weren't permitted to take the 50% of ATI in 2019 and that they were left with the 30% of ATI?
John, thank you for that, and thank you for the question. But before I answer it, a few other thank yous and a disclaimer. I want to thank the ABA and Sarah for having me here today. I want to thank John, Mark, and Shamik for all their work they put in making the slides. And now the obligatory disclaimer. I am participating as a staff member for the Joint Committee of Taxation in an official capacity. However, all statements and opinions are my own, and I do not speak for the Joint Committee or any member of Congress. So you should focus on making lunch, a post-lunch snack. Anytime I speak, your kitchen is very close to your office right now. So back to the question. Why is there a separate rule for partnerships as opposed to other taxpayers? I think it's helpful to start with the big picture. The CARES Act is intended to provide liquidity to taxpayers. One way to provide liquidity to taxpayers is allow taxpayers to monetize existing tax attributes. And this approach was taken with respect to many CARES Act provisions, including the rules with respect to NOLs, which John just discussed, and the corporate AMT. As John mentioned, when a taxpayer other than a partnership faces a 163J limitation, the 163J tax attribute is disallowed business interest expense, which is a taxpayer level attribute. When a partnership faces a 163J limitation, the applicable tax attribute is excess business interest expense, which, as John mentioned, is carried forward at the partner level. To quickly monetize disallowed business interest expense paid or incurred by a non-partnership taxpayer, increasing the percentage of ATI taken into account for 2019 was a viable path. In the partnership context, this approach was problematic, in my personal view, for at least two reasons. First, a BBA partnership that already filed a 2019 return would have potential issues if used a 50% of ATI concept, as this could delay the cash transfer from the government until 2022. And the reasons Shamik described with respect to how the BBA operates explains why. Second, the idea of making partnerships redo the 11 steps and then partners redo partner level computations while most of the country is working from home just seemed not fun. So using a rule that freed EBIE alleviated those concerns and was consistent with the idea of monetizing existing tax attributes. Excess business interest expense in the case of partnership level interest expense that was disallowed under 163J. And as John noted, the results of using a 50% of ATI rule versus a 50% of EBI rule are not equivalent. In some cases, as John pointed out in his example, the results are more generous to partnerships. In other cases, specifically where and I think these numbers are right, the amount of business interest expense of the partnership is between 30% and 70% of the partnership's 2019 ATI. The partnership-specific rule is less generous. I think the idea is rough justice in the name of liquidity. John, does that answer your question?
Yes, that's great. Thanks, Manisha. And I think not fun associated with the 11 steps doesn't have description, and I appreciate not having to redo the 11 steps. So we mentioned there are a lot of these changes on the previous slide, and they're all subject to really electing in or electing out. So a taxpayer can elect out of the 50% of ATI rule. A partner could elect out of the 50% of excess business interest expense automatic deductibility rule, and a taxpayer can elect to apply their 2019 ATI to their 2020 tax year. One issue that came up and that we've gotten some questions about, and I'll ask you, Manisha, is if specifically with respect to the election out of the 50% of ATI rule. I think there are some taxpayers that would like to elect out, and I mean, I'll ask you the reason for that, but I think it had to do with some international concerns specifically. And then another question was, can you elect out, let's say, for the 2019 tax year and choose not to elect out of the 50% rule for your 2020 tax year? I think RevProc 2020-22 gave us some indication of the answer to that, but I'll ask you the question.
So the intent with respect to whether you could elect out for one or both years was that you could elect out for one or both. So you could elect out for 2019, but not 2020, or elect out for 2020 and not 2019. as you pointed out and Shamik pointed out earlier, there's a lot of flexibility in the CARES Act. To answer the earlier question, I was personally aware that a mandatory increase in the amount of deductible business interest expense, thus decreasing taxable income, could create a permanent tax detriment to some taxpayers who were subject to tax under the BEAT or Section 250. And just to say it, Section 250 contains the GILTI and FDII rules. So the rule with the many elections allows 163J to continue to function as a deferral provision and not create and avoid the change that could be viewed to create a permanent disallowance. And to understand why you would have a permanent disallowance, you have to go to the GILTI regs, and I'm going to give an explanation in the interest of time.
Okay, thank you. So, yeah, as you mentioned, a lot of flexibility there, whether how you in electing out for any of these particular provisions or electing into the application of the 2019 ATI to 2020 rule. Those specific rules, I'm not going to go into the specific procedures for making those elections, but they're in Rev Proc 2020-22. On the third bullet on this slide is again, as we mentioned, you can elect to apply the 2019 ATI to a 2020 limitation computation. With respect to partnerships in particular, one issue that has come up, and I'll just point out for folks listening, is if you were thinking about engaging in a restructuring, and we had some clients thinking about this, engaging in a restructuring really in an effort to increase their overall 163J limitation by, let's say, combining trades or businesses into that might have been separate partnerships into a single holding partnership. And so that whole single holding partnership is treated as a new entity for tax purposes. It's not a continuation of one of the old entities. You're creating a new partnership. All the old partnerships are going to stay alive. All the assets and liabilities are going to move into this partnership with the intent of creating an overall larger enterprise, more opportunity for ATI, hopefully a bigger 163J limitation. Thinking about that in the context of where we are today, number one, with the downturn in the economy that may end up not being true. So in 2020, if you engage in this restructuring, you might end up really not being in a better place. Looking at the CARES Act changes to Section 163J, which allows you to take into account your 2019 ATI, the problem with this sort of restructuring would be that if we form a new partnership, it's not clear to me that this new partnership would have any 2019 ATI to look to. So that you, in effect, by restructuring your ownership to increase your overall 163J limitation, you might, in effect, be reducing your ability to take business interest expense because you don't have a 2019 year to look to for the particular entity that you're dealing with. Second, a big issue that's come up, and I understand the Treasury is working on guidance on this, but is how do you apply the 11 steps to a partnership that is applying their 2019 ATI to their 2020 limitation, when the 11 steps are really aimed at allocating deductible interest expense to partners based on their allocation of the income items that created the adjusted taxable income for the partnership. And when you're applying 2019 ATI to 2020, you could have a situation where in 2020 you actually have no income. Let's say you just have losses. It's a terrible year. And so you're allocating losses to all your partners, but your 2019 ATI is positive. You had income in 2019. How do you go about allocating that 2019 ATI or the deductible interest expense for 2020 based on that ATI to the various partners, considering that you have no, let's say, net taxable income to allocate to your partners? So there, in the absence of guidance, there may be various reasonable methods that we've been thinking through and how to do that, but there is no particular guidance on how to do that. But I think Treasury is aware of that issue, and hopefully we'll get some guidance on how to deal with that. Go ahead, Madisha.
I would happen to agree those are both very detailed issues, and Treasury guidance would be most welcomed by taxpayers.
Yeah, very agreed with that. on the next slide, let's talk about a little bit about the 50% of 2019 EBIE deduction. This is the automatic deduction. So one question that has come up is, what if you have a disposition of all or substantially all of your partnership interest? Let's say at the end of 2019, you had a disposition. So normally under the 163J rules that we all know well back from 2018, if you had excess business interest expense allocated to a partner, that reduces their tax basis and their partnership interest. But if that partner then disposes of their partnership interest prior to taking that excess business interest expense into account as paid or accrued by the partner, there's an offsetting basis increase to the partner's interest immediately before disposition. And so what if you had a situation where the CARES Act came out and you happened to, let's say, check the box on your partnership so that you became a corporation effective January 1st of 2020. So the effective date of the liquidation of the partnership would have been, I think, December 31st, 2019. Would you be able to still take advantage of this 50% of 2019 EBIE deduction? Let's say you were allocated some EBIE in 2019 prior to disposing of your interest or being treated as disposing of your interest. Would you be able to take that 50% deduction? And I think the answer is probably not. I'm interested, Monisha, what in terms of the intent of the statute, what you think the answer is.
I read the statutory language of 163J as consistent with the result you just described. I think the language in the last sentence of J4's disposition rule in J4's disposition rule provides that no deduction shall be allowed to the transferee or transferor for any EBIE that results in a basis increase. And if that pattern John describes, if I'm thinking about it correctly, there would be a basis increase at the end of 2019, and thus that tax attribute is already used. So I think it's consistent with the fact that the CARES Act is about monetizing existing tax attributes, not previously used tax attributes.
Right, okay, so that's consistent with how I read it. And then the more, I guess, the harder question might be, what if you dispose of your partnership interest in 2020, at some point in 2020? I guess one question is, when does the 2019 50% automatic deduction accrue? It seems that a partner is eligible for that deduction as of the beginning of 2020, at least the way I read it. There doesn't seem to be a passage of time that's required in order to take into account that, or that ability to take the 2019 EBI deduction. Is that something you considered?
I mean, I think the statutory language can be read in multiple reasonable ways. I think the fact that the taxpayer takes, or the partner takes into account the deduction in its first taxable year in 2020 is consistent with the way you're reading it personally. So that is one reasonable way to view the statute, or some could argue as such.
Okay, yeah, and that has come up. So if let's say you're computing your estimated taxes for your first quarter of 2020, that may mean that the deduction is accruing in the first quarter and could impact your calculation of your estimated taxes. It also brings up, what if you have a disposition of your interest at some point in 2020? Do you retain that 2019 EBIE 50% deduction, or do you lose it because you disposed of your partnership interest? I personally don't think it's entirely clear from the statutory language, but I think the better answer probably is that you still get to take the deduction, especially if the deduction is accruing as of the beginning of 2020. And I don't know if you have anything to add to that, Monisha. Otherwise,
I think you can read I think one could read the statutory language the way you're reading it.
Okay, great, thank you. Quickly, I'll just move through just a couple other points. Another point to consider with 163J in particular, debt finance distributions. Of course, we're still waiting for final regulations and a new set of proposed regulations from Treasury on 163J. I think those may contain some rules on debt finance distributions and how to deal with those. In the meantime, we've got the old notices in play, Notice 8935, 8837, and 8820. And those would historically suggest that the interest expense from a debt finance distribution is allocated out to the partner, and that's where the interest expense gets characterized. I think that may be somewhat inconsistent with the way 163J operates, which requires interest expense to be tested at the partnership level. And so in the absence of guidance, there may be some flexibility in how you treat that finance distribution interest. And just note that if you treat it as, for 2019, if you treat it as interest expense that needs to be tested at the partnership level, you're going to be subject to a 30% of ATI limitation. Whereas if you can find your way to treat it under the notices and have it go out to the partners and characterize it at the partner level, that may give you the opportunity to use the 50% of ATI limitation for 2019, assuming that your partner is not also a partnership. With these changes to Section 163J, and of course the change, which I'll talk about quickly in a minute, the QIP technical correction, which allows QIP now to be eligible for bonus depreciation. Taxpayers were very concerned about real property, trade, or business elections that they may have made for 2018 or 2019, and were inquiring about the possibility of either withdrawing those elections or potentially making elections late, given the rules have changed a little bit. And so RevProc 2020-22 issued a few weeks ago does provide that flexibility. So a taxpayer can now withdraw or make a real property, trade, or business election for 2018, 2019, or 2020. That has to be done on an amended return in accordance with the BVA provisions that Shamik went through a few minutes ago, or an AAR administrative adjustment request. So you definitely want to keep in mind that flexibility, and that's another aspect of the modeling that needs to go on. I know we're running short on time. I just mentioned quickly qualified improvement property. We all know there was an issue with the TCJA. It definitely took this disaster of COVID-19 to allow Congress to make the technical correction, which we were all waiting for, to the treatment of qualified improvement property, giving QIP a 15-year recovery period under the general depreciation system, which allows QIP to be eligible for bonus depreciation. Monisha, I'll just ask you one question on QIP before we go on. There was an additional language put into the definition of QIP that it has to be any improvement made by the taxpayer. Now, if you want to elaborate on the purpose of that additional language.
Thanks, John. So let's start with an example, since examples are helpful, at least to me. So buyer buys building from a seller. The seller had previously placed the property into service. None of the building in the buyer's hand is qualified improvement property. This language is supposed to make it clear. So why the need for the clarification? After the passage of the Tax Cuts and Jobs Act back in 2017, there were articles suggesting that part of the building in that fact pattern could be treated as qualified improvement property in the hands of the buyer. And these articles suggested that cost aggregation studies could be used to determine the appropriate amount treated as qualified improvement property. Congress didn't view this as an appropriate result. So that's the reason. In the partnership-specific context, since we're on a panel addressing partnerships, I think it's worth noting that my view is that the made by the taxpayer language prevents treating a 743B adjustment as allocable to qualified improvement property.
Okay, thank you. And I'll just mention real quick, in terms of now we've got this change to the treatment of QIP in the recovery period, both under general depreciation system and ADS, that requires method changes. You also may choose to go back and take bonus depreciation on QIP. Also requires a change to the treatment of the depreciation of QIP. So how do you do that? RevProc 2020-25 came in and gives us quite a bit of flexibility in terms of how you go about making changes for QIP, but it doesn't only apply to QIP. It can apply to elections made for depreciation purposes more generally, and allows changes to be made generally on an amended return, an AAR, or an automatic method change on Form 3115. And as Shamik mentioned earlier, all of those different options bring in timing considerations. When exactly are you going to take into account this change? And so again, I think this goes into your matrix, your modeling matrix, to determine exactly how you should go about taking advantage of these changes. The last thing I'll just mention really fast, disaster losses. Taxpayers asking a lot of questions about Section 165I. Generally, a disaster loss under Section 165I, if you qualify, although the loss may arise in the 2020 tax year as a result of the COVID-19 disaster, because COVID-19 has been, the entire nation has been declared a disaster area as a result of COVID-19 by the President on March 13th, the losses that are attributable to COVID-19 are eligible for Section 165I and can actually be taken into account on your 2019 tax return instead of your 2020 tax return, which gives you the ability to take into account these losses sooner with the filing of your 2019 return, again, reducing your tax liability, potentially creating an NOL and the ability to carry that back. And slide 28 gives some examples of the sort of losses that may give rise to a disaster loss under Section 165I. And it's got to be, there's got to be a recognition of the loss. You have to have tax basis in an asset. It could be a tangible or intangible asset, but you have to have basis in the asset to, in order to take the loss. And importantly, you need to demonstrate a strong connection to COVID-19 as creating the loss. So there is documentation that needs to be shown. You need to be able to show causation there. So that is an important element of Section 165I. It appears to me that Section 165I in the partnership context needs to be elected at the partnership level. I don't think that's 100% clear, but the instructions for taking the loss on Form 4868 seem to suggest that a partnership can make the election. Section 703B and the regulations under Section 703 also suggest that if you have an election that impacts the taxable income of a partnership, that's an election that is made by the partnership. So I think it appears to be a partnership level election, which could create some pass-through issues, especially if you've got changes in partners between your 2019 tax year and your 2020 tax year. Changes in allocations, you're in a different part of the waterfall between the two tax years. It could impact computations that you've made for your 2019 tax year, such as under Section 163J or Section 199 Cap A. So you need to take into account all of these elements in determining whether to take into account a disaster loss in 2019 or to leave it as a loss that you take into account in your 2020 tax year. With that, I think I'm going to pass it over to Mark to talk about some specific real estate tax issues.
All right. Thank you, John. And I guess I'm the last person on the relay here, so we can go as we need. If we run out of time, we run out of time. So on retroactive cost segregation opportunity slide, taxpayers are asking, what can I, you know, how else can I get refunds? One way of doing that is to consider now, if you haven't already done so, a cost segregation study of property acquired in a prior tax year. And it sounds almost too good to be true that you can go back and get a deduction for property that you might have purchased in 2015 or 2014 or whenever. But the answer is yes. You may, if you purchased real estate and you've been depreciating it at a straight line rate over the last few years, and now you have the ability, maybe you're a real estate professional, to get operating losses out of real estate and potentially even carry them back. You can do a cost segregation study now, a retroactive cost segregation study. The engineers tell me they go back. They go back 5-7 years for sure. And you would do that study, and it would break the building up into component parts, which might be classified as typically 7-year or 15-year class lives, getting a potentially a 5 or 7-year or sometimes 15-year recovery period for depreciation purposes. Along the way, you may have also made improvements, and to the extent those improvements would have qualified as qualified improvement property along the way, you might even have a chance at bonus depreciation. So how do you get the refund now currently? Well, typically because of the method of accounting rules, you cannot, unless it's only 1 year of method, you can't change your depreciation methods through amended returns for 2015, 2016, 2017, et cetera. But you can do what Shamik was talking about. You can do a change in method of accounting to a permissible depreciation method, and you would make what Shamik referred to as a 481 adjustment, which would essentially allow you on the 2019 return, assuming that's the return that you're now filing, on the 2019 return to report a potentially significant deduction for all of the allowable depreciation that you would have had in the prior years using either a 200% double declining balance method or 150 declining balance depreciation method, or potentially even bonus depreciation for certain property that qualified as qualified improvement property, any improvements you made along the way to the building, if it's commercial property. And you get that in 2019, and now with the possibility of carrybacks, you can carry back that loss. If it creates a loss in 2019, you get to carry it back 5 years. And that could mean a significant refund opportunity. There are some things to keep in mind. There is this case, Pico Foods, that if you buy real estate and if you buy real estate and you did enter into an asset allocation agreement, and the real estate is a trade or business, you have to look at all these rules that the IRS has or Congress has enacted in the code, that maybe you cannot now do a retroactive cost segregation study. It's just item beware. In general, we work with a lot of real estate transactions at my firm, and clearly you're going to avoid, whatever you're buying, if you have in mind a cost segregation study, you're not going to put a binding allocation agreement provision into that purchase and sale agreement to the extent you can avoid it. Something else to keep in mind is you might not have a lot of basis if it was 1031 property, and the property was acquired as replacement property because of the carryover basis rule. However, if you made significant amount of improvements over the years, there actually may be significant benefits to a cost segregation study. Okay, so then moving to the next slide. I just wanted to throw in that there is a state tax issue, to always check on refunds. So a lot of times, some states are fixed date conformity states, to use SALT lingo. Some states are selective conformity. New York is quote unquote rolling conformity. And I'll talk about New York. I mean, New York and New York City decoupled, for instance, from the CARES Act, which generally, for purposes of this conversation, means that for New York State and New York City personal income tax purposes, the states are not conforming to the CARES Act. There are no carrybacks. Okay, so as indicated in the slide, the top rate is 8.82% for New York State. Top rate for New York City is 3.876% on the personal income tax side. That's an 11-12% haircut you're going to be getting. So you're going to get a federal tax benefit from the carrybacks. You're not going to see a refund for New York purposes. Moreover, you're basically not going to ever see any benefit from those loss deductions that you're carrying back for New York State and New York City personal income tax purposes because they'd be used up. For federal, New York State, New York City, just to say it, don't have, and other states may or may not be the same way, don't have a specific provision for carrybacks other than to say it's the deduction allowed under 172 of the federal code. Federally, you don't have carry forwards, so you're not going to have carry forwards either for New York State and New York City purposes. For New York State and New York City, for those on the line who care, New York, they've also decoupled from bonus depreciation for qualified property. So what we're talking about, what John just mentioned very quickly at the end there, you kind of ran out of time, unfortunately, but for qualified improvement property, New York has always been on a straight line depreciation method and does not allow for bonus depreciation. Other states are similar to that. Lots of states are dealing right now, not just to focus on New York, I mean, lots of states right now are dealing with refunds from carrybacks and what they're going to do about it. And it's going to be state by state, wherever the property is. And with, I'm thinking in terms of real estate, but real estate is involved also with, businesses. If you purchase a business and there's real estate aspect to the business, these things come up. All right, moving to the next slide. This is a hot issue right now. For those of you who have clients who do 1031 exchanges, there's a huge hole right now in the guidance as to how the extensions and postponements apply with respect to 1031 exchanges. The notice that Shamik referred to earlier, notice 2020-23, referred to provide for extensions with respect to certain time-sensitive actions, and those time-sensitive actions include actions to be listed in Revenue Procedure 2018-58. Revenue Procedure 2018-58, Section 6, includes Section 1031 exchanges and 45-day identification period for 1031 exchanges, and also the 180-day exchange period deadline for 1031 exchanges. RevProc 2018-58 also says if the IRS news, if I'm quoting here, if an IRS news release or other guidance is issued with respect to a specific federally declared disaster and authorizes postponement of acts in this revenue procedure, affected taxpayers may use the postponement rules provided in Section 17 of this revenue procedure in lieu of Section 6. So that would mean, and we're going to get to what Section 17 says in a second, problem is that revenue procedure, that the notice 2020-23 says, contrary to that somewhat, the time-sensitive acts to be performed on or after April 1, 2020 and before July 15th, taxpayers will have until July 15th to perform those acts. Okay, but Section 17 says something very different, which is to give taxpayers much longer than until past July 15th to perform these acts. And I'll just tell you what Section 17 says. Section 17, if taxpayers could apply it, would say that as long as the property is sold on or before the date of the federally declared disaster, and just to say it, we have so little time right now, but just to say it, the date of disaster is pretty much every day of this incident, of this COVID-19 incident. So each day is a new date of disaster. Then the 45-day identification deadline falling after the disaster, after that date essentially, is postponed by 120 days, or if later to the last day of the general extension period of the disaster. And the 180 days also gets a 120-day postponement. So effectively, you get 165 days to identify and 300 days to complete your exchange. The RevProc, Section 17 of the 2018 RevProc also says even if the 45-day ID period fell before the date of disaster, the ID deadline will get also another 120 days if the identified replacement property is damaged by COVID-19 or by the disaster, and no postponement period as general rule can be extended beyond the due date of return, including extensions or 1 year. So you have an isolated disaster loss. Just think conceptually here. Say there was a disaster, a flood. Flood's a bad one because floods have an extended day. I wanted just a single day disaster. Say it happened May 31. So Section 17 would say, in a general case, if you sold or relinquished on May 15th, your 45-day extension, and the flood happened on May 31, and you were affected to the extent that your replacement property was damaged in the flood, for instance, then you have 120 days to identify your 45-day deadline is extended by 120 days, and your 180-day deadline is extended by 120 days. That looks too good to be true. Think of it this way. If you're extending the 45-day identification deadline by 120 days, that's going to take you to day 165 to identify. The idea of not extending the 180-day exchange period deadline seems silly, because that would mean Congress gave you 100, or Treasury gave you 165 days to identify, but then you only have another 15 days to complete the sale. So that you get a 120-day extension on the 180-day deadline as well. I'll say this, that when did the disaster period start for COVID-19 is a huge issue as well. April 1, obviously Treasury came out in Notice 20-23 with just broadly saying we're going to talk about acts between April 1 and July 14th. But, there are better dates, for instance, the date of and that has to do with what Shamik was talking about. We don't want taxpayers going back, and Monisha as well, we don't want taxpayers who've already done things before the notice came out to have to, to change the rules for everyone. Administratively, it's a nightmare. So we'll make it April 1, approximately that first week of April when this notice came out. But frankly, the disaster declaration was declared by the president on March 13th, and FEMA declared the disasters to happen as of January 20th. So really, we have a lot of taxpayers who are in a situation where stuff they identified from sales prior to January 20th, which would be covered by the RevProc, are not. And for exchanges, there's a lot of deals that are falling through because of COVID-19, and April 1 is not helping those exchanges. I'm going to skip the second part. You can always ask me questions and reach out to me if you have questions, but just to put a map on what it might look like. Right now, what the qualified intermediaries are telling people is the most conservative view, that you have until July 15th to identify if your ID deadline fell between April 1 and July 14th. And if your exchange 180-day deadline fell between April 1 and July 14th, you have until July 15th to complete the exchange. And that's it, because that's all that they're comfortable doing, given the inconsistency with the RevProc. But however, what taxpayers would prefer, for sure, is a clarification. This alternative number 2 applies, namely, yes, taxpayers can elect. 2018-58 was by referencing therein, it was intended not to limit actions to be performed until July 15th, but that taxpayers would have the full benefit of Section 17 of the RevProc. I think that most people in the qualified industry, 1031 industry, think it requires clarification by Treasury. And certainly there are groups, including the ABA tax section, the Federal Exchange Accommodators group. We're all trying to get Treasury to focus on it and just say, yes, that was the intent. We didn't intend for 1031, which has this special rule in RevProc 2018-58. We didn't intend to say that taxpayers could not utilize the special rule in the earlier 2018 RevProc. But I think people think you need clarification on that point. Okay, I'll stop quickly. Sorry, out of time.
No worries. Thank you very much, Mark. So now we're going to open it up to the question and answer period. We already received some questions on the chat feature, the webinar chat feature, and I'm going to just kick right off. This question is for Shamik, and the question is, if the Form 1040 was not filed before the receipt of the amended K-1, are you suggesting that someone would have to file their original 1040 based on the original Schedule K-1 and then an amended 1040 using the amended K-1, or could they just file the Form 1040 in the first instance using the amended K-1?
Thanks, Sarah. So I think what the question is asking is really related to the filing of a superseded return or a return that's being filed within the extension period that receives updated information returns. So for 2018, if your 1040 was not filed for the 2018 tax year, then it's late. So you could file your original late 1040 with the amended K-1 to reflect whatever treatment would be on your original 1040. If you already filed your 2018 1040 and you get an amended K-1, then you'd have to amend your 1040 with the information reflected on the amended K-1. If it's 2019 and you haven't filed because you have extended and you have until October, and your 2019 partnership has filed and is issuing to you an amended K-1, then I think you would file your 2019 return timely, originally, with the amended K-1 that reflects the correct treatment of those items on the partnership to the partner. Great,
thank you. Shamik, we have another question for you too. While I have you, how do AARs, the Administrative Adjustment Requests, how does that marry up to state filing requirements?
Yeah, so that's an interesting topic because not all the states have adopted BBA legislation. So by no means am I a SALT expert. I don't play one on TV either. It just requires the practitioner or the partner to ascertain whether that particular jurisdiction has a similar BBA statute. So some states have adopted legislation that would marry the federal BBA rules with the state rules. Some states have not. So it's sort of the Wild West to some extent on what you would do with a particular state that does not have a BBA provision. And the question actually jogs my memory. I didn't address this earlier, which is obviously one of the downsides of filing an amended return, to your question, Sarah, is that it would be also requiring you to file an amended return in a number of different jurisdictions potentially. So that might also play into the cost element of, am I amending one 1065 or am I amending multiple returns as a result of my state tax liability?
Great. Thank you very much. Mark, you touched on this a little bit in your part, but I guess how, in your view, how significant for 1031 exchanges is the fact that Notice 2023 only impacts additions to be formed on or after April 1st? It doesn't include, anything that was supposed to, any acts that were supposed to have taken place prior to April 1st. Mark, are you there?
Sorry, I'm here. Sorry, that's
okay,
lost
no
of precious seconds. Okay, so it's very significant. Clearly, the qualified intermediate, for 1031 in 1031 world, there were a lot of identifications that happened well within the January 20th through March 31st period that are now going to be lost, and 1031 exchanges are going to fall through with significant tax consequences, namely recognition of income for an intended 1031 exchange that through no fault of the taxpayer's own died within the COVID-19 crisis. In some cases, for instance, you could have had a closing on March 25th. And whatever had to be done prior to that, removing title impediments, who knows what, got delayed, couldn't get done. I mean, you have huge problems, and it's quite unfair that that for exchangers to have basically have lost their exchange possibility because of that. I'll mention, because there's 10 seconds left, opportunity zones. Not much relief for opportunity zones because opportunity zones are not an act reflected in RevProc 2018-58. And so the best the Treasury came up with was to say that taxpayers also have the extension to July 15th also applies to investments in qualified opportunity funds. But other than that, there's not much relief offered there.
Yeah, just the 180-day period to invest.
Right.
We didn't talk about, just because of the limited time, we have a couple minutes left, and we received a couple questions on this issue, which is the Payroll Protection Program. I understand the ABA did another webinar that was just devoted to the PPP program. But I'll just throw this out to all the presenters. So Notice 2020-32 that was recently issued does not allow for deductions associated with PPP loans. If that notice is overturned so that deductions of payroll costs, rent, et cetera, are allowed, the question is, won't there be gain if money is distributed, since there will be no cancellation of indebtedness income or other income to increase basis? And this is obviously in a partnership.
Don, I'm certainly no PPP expert, but it does seem that it creates a potential basis issue. If you are able to take those expense deductions in the first instance, so you lowered your basis, there does seem that if upon the cancellation of the debt, if it is treated as debt for federal income tax purposes where you would normally have COD income, upon cancellation, if you're not having COD income, you're not going to get an offsetting basis increase. And so a later distribution of cash would seem to more likely be a distribution in excess of your outside basis. So it may just be a timing issue in terms of when you're recognizing gain or income, but yeah, I think there is a potential mismatch there.
Great. Well, that takes us right to 12:35 on the dot. So thank you very much to all of our presenters today, and thank you to everyone who listened in. If you have any questions for us, you can find all of our contact information on the web, and feel free to reach out. And with that, I will turn it back over to the operator to, I think they have a couple housekeeping items about CLE.
Thank you very much. To our faculty for this program, Shamik Trivedi, Mark Walensky, Monisha Santamaria, Sarah Harridan, and John Finkelstein, thank you so much for sharing your expertise with us. On behalf of the ABA, thank you all for joining us. Before leaving, wait for the evaluation to come up on your screen. We would like to thank you for participating in this program. To learn more about the sponsors, visit the ABA website at americanbar.org. And you can now click on the evaluation link. We do value your feedback.